Hello and welcome friend. Let us take part 2 of the same problem which we have started solving from the last lecture. In this case, now we are going to cover the point that if selling price is increased by 10%, that means if at present the situation is like this and now the firm increases the selling price or firm decides to increase the selling price by 10%. What will be the effect of this decision on all these parameters? First of all, the selling price itself will change. Revised selling price, we should use the word revised selling price. Now everything we are going to calculate will be revised. Existing is 10 rupees, increase means plus 10%. That means the new or revised selling price will be rupees 11 per unit against the 10 at present. That will change the contribution per unit because contribution is selling price minus variable cost. Since there is no change in variable cost, we have been given the information that selling price is increased by 10%. That will not affect the variable cost because the variable cost is determined by the external forces, not the internal forces of the firm. So it will be now 11 minus 6. So the contribution is now rupees 5 against 4 rupees. Yes, it has increased. In brackets we will write our comment, or rather comment about the effect of this decision. After contribution, this is term of PV ratio, reverse PV ratio. Now it will be as usual contribution upon selling price, but revised contribution is 5, revised selling price is 11. So it is now 5 by 11. 5 by 11. We are going to write the exact answer. 5 divided by 11, that is 0.4545. 0.4545, that means 45.45%. Now see, in the existing situation the PV ratio is 0.4 or 40%. Against it now it can be rather 45.45%. So it has also increased because of increase in the selling price by 10%. Now BEP. And in BEP, we are first going to calculate break-even sales quantity, that will be fixed cost upon contribution per unit. There is change in selling price only as say our decision making or internal factor. Fixed cost will change only as effect of the external factor or factors. So there will be no change in fixed cost because of change in selling price by us. So it will remain rupees 30,000. But now the contribution has increased to 5 against 4. So the break-even sales quantity comes to 6,000 units. Break-even point has decreased. We can now reach the break-even stage at earlier point of time in our accounting or financial year. If we presume that the sales of 10,000 units per annum or per one period remains the same, now the break-even point or break-even quantity is 6,000 units against 7,500 units at present. So under this scenario, we shall reach the break-even situation at earlier point of time against this situation. Break-even sales value will be revised break-even quantity into revised price. So it is now rupees 66,000 against existing rupees 75,000. So in both the terms the break-even point has decreased. In quantity it can be now 6,000 against 7,500 units, and in terms of amount or value it can be now rupees 66,000. Even though there is increase in selling price, we have multiplied it by 11 now against 75,000. Now what will happen with the margin of safety? Now revised margin of safety quantity will be 10,000 units, that actual sales we are making, and against it break even point will be now 6,000. So it comes to now 4,000 units, which was, or rather under the existing situation, which is 2,500 units. A great jump in margin of safety. That is very good, or say excellent type of effect on the firm's financial health. It has increased in terms of rupees, it has increased too much, because now 4,000 units will be multiplied by the revised selling price of rupees 11. So it will be rupees 44,000. The margin of safety also shows the quantity or the revenue which works as buffer in case of, say, starting of the time of depression. If the time of depression starts and sales starts to decrease, this is the amount of buffer. Before entering the loss-making situation, we can sustain this much decrease in sales. Till this much decrease in sales, we shall not have to face the loss-making situation. This is another angle to interpret the margin of safety. And the last thing, sorry, not last, as we have added this voluntarily, sales to earn profit of rupees 5,000. Okay, let us use the same formula of required sales. This is a versatile formula. In marginal costing, this is my favorite formula, because we can say make many different kinds of calculation through this only one formula. So friends, I strongly recommend you to remember this formula and always to think over this formula, always to think over the versatility of this formula. This is like say Midas touch. Anything in marginal costing can be sold. I dare to say these words, because this is a very useful formula, but very easy formula. Fixed cost plus profit. This is the limitation of this kind of instruments, divided by contribution per unit. Fixed cost is 30,000, profit desired is 5,000, but now the contribution is rupees 5,000 per unit. So ultimately it is something like this: 35,000 desired contribution per unit is 5. So the required sales comes to 7,000 units. Now under the new situation, if we have increased the selling price by 10%, we need sales of 7,000 units only to earn a profit of rupees 5,000, which at present is 8,750 units. A considerable decrease of 1,750 units in the required sales to earn the same profit. This is the effect of increase in selling price. But in real life, to increase the selling price is not that much easier, because we have to consider so many factors like paying capacity of customers or consumers, pricing policy of competitors, etc., etc. But these are the hypothetical situations. We are just examining the effects of such kind of situations. And in terms of rupees, it will be 7,000 into 11 rupees, so it will be 77,000 rupees. That is also less than the existing amount of rupees 87,500. And last, the thing we have voluntarily included, profit at present at a sales of 10,000 units. We believe that even if we increase the selling price by 10%, our periodical sales is going to remain 10,000 units as it is at present. Then what will happen? Again we are using the same formula, required sales formula, or we cannot write this word required because we are not going to calculate the sales. Sales equals to fixed cost plus profit upon CPU. We can write this kind of wordings. Now what is going to happen? Sales is 10,000 units, where fixed cost 30,000 plus profit is missing and contribution is 5. So cross multiplication gives 50,000. So profit comes to rupees 20,000. At present it is 10,000 rupees at the sale of 10,000 units. But now at the sale of 10,000 units the profit will be 20,000. Effect of increase of rupee 1 or 10% in selling price. See, we have increased the selling price by rupee 1. 10,000 units of our sales. So ultimately we can conclude that the increase in selling price has contributed directly into the increase in profit. The whole increase in selling price has resulted into increase in profit. So far as the basic principles of socialism are concerned, we must or we ought to take them into consideration, and as a manufacturer or seller we should not increase the selling price in this way, but these are hypothetical situations. We need to study the effects of such type of situations, but from which we can learn some lessons only. Also, I believe in socialism up to certain extent. I am not a socialist, I am not a communist, I was never a communist, but we should follow some natural discipline. That is another thing. Okay, so this is the study of effect of the decision of increasing selling price by 10%. In the next lecture, we are going to study the effects of decision of decreasing the selling price by 10%. And logically we can say that if the increase in selling price increases the contribution, decreases the break-even point, the decision of decreasing selling price can create exactly reverse effect. That's it for now. Thank you very much.